All right. Okay. Um, so I just wanted to repeat that I repeatedly repeat on this repeating channel. I don't say anything new. Don't invest in single stocks. Don't try to beat the market. Don't try to make quick money. It's not going to work out for you. You're going to end up getting burnt. It's just exactly what happens. The almost all of the finance literature, accounting literature will tell you that you cannot beat the market. You're going to get slammed if you try to do that. There's far more smarter people out in the world than you are. Just invest in broad-based mutual funds that have been around for a long time, or invest in index funds. Both of them are totally fine. So if you don't know me, I am Professor Dave Maslach. I'm an Associate Professor of Innovation Strategy and Entrepreneurship. And I created this whole reciprocity project to give back as much as I possibly can. There's so many people that help me out that I want to pay the favor for, to help you out as much as I possibly can. Drinking a Coke right now. So just don't go there. And I have to repeatedly say this. You're going to be tempted to play the stock market because the way that it's set up. In fact, almost anybody that studies this stuff, that understands about finance or accounting, they'll say that that is the stupidest idea ever. And the reason is that the market corrects for people being silly on there, and it's impossible to beat the market. Now, I want you to sort of think about I want you to think about somebody coming up and sort of figuring out what is the value on a particular asset, right? So somebody goes in and they undervalue that asset. Well, the seller is not going to sell it at that particular price. You know, this is the way the stock market works. It's the way that anything works. It's, I think they call it capital asset pricing, is the sort of formal name, and people have studied this for a long time, and they're not going to sell it. So what ends up happening is that the seller is going to want you to get to a certain amount, right, before that they actually sell it. And once it gets to that certain amount, then you can actually buy that particular thing. Now, if it was undervalued, let's say that the seller was stupid, right, and they couldn't understand anything. They had no perception of what their asset is. By the way, it's actually the opposite. The seller is it's called the winner's curse. The seller has, actually, it's not the winner's curse. It's called the market for lemons. So the seller has more information than you do as the buyer, because that they understand all the particular assets. Now, it's a little different in the stock market because we don't necessarily know the underlying value of the asset. It's kind of hard to understand. But if they understand that particular value, then what they're going to do is they're going to hold out until the buyer actually overpays for that particular asset. Now, what will happen is, if there is a third player in the market, that's really all you need is, 2 people, 3 people that are in the market. They're paying attention to that, right? So that's a pretty small market. That's extraordinarily small market. If you sort of think about it, it's like a couple of players. They're going to be looking at that and they're going to say, hey, that was undervalued. I think I can come in and actually buy this particular thing because I have some inside information, or, that there's something out there. It's called the efficient market hypothesis. And what they're doing is, maybe they're a little bit more astute, right, than somebody else, or they've been reading a little bit more and they understand the value of the asset. And so they are going to jump in. Now, let's say that all 3 of them are completely stupid, which is, chances are that's actually not true. That's pretty hard at that point to have 3 people, completely separate, independent people, to make really stupid decisions. Let's say that there's a 4th person, and then a 5th person, and a 6th person, and pretty soon, you get up to 100 people, you get up to 1,000 people, which is more like the stock market. You brought in all of this information, and what they're doing is it's getting priced appropriately at exactly what it should be worth. Now, people are also making an expectation for the future. So they're thinking everybody else, just like you, is saying, hey, this thing is undervalued or this thing's overvalued, and they're going to play the particular market. And it's bloody hard to beat any particular individual in that circumstance because so many people are playing in. In the stock market, the real deal stock market, it's virtually impossible to actually beat the market and outsmart. In fact, the finance people would say it's impossible. The only time that you can actually beat the market is if, for some reason, you have some private information, which is illegal, or that there is some mass hysteria about a particular thing and everybody has gone bonkers. That I don't fundamentally believe that there could be some mass hysteria about, lots of people can sort of be bonkers. I suppose it's possible that there is moments in history where we have mass hysteria, but at the time it doesn't, those people that are in that group, they don't understand it. There might be some people that are high and mighty and they think that is not mass hysteria, or that is mass hysteria at that time, but 9 times out of 10, more like 9 times out of 10 million, they're wrong. It is what it is, right? And that's what you have to sort of think about. It is what it is. So how do you invest? How do you actually, what are you supposed to do? Think about the long term. What you do is you bet on the economy. You bet on where things are going to be in 10, 20, 30 years, right? So that's why I just invest and the only reason I invest in mutual funds is simply because that's what is offered in my 403b. Anything outside of my 403b is equivalent of the 401k, but for private education or for public schools and things like that. Anything outside of that, I just do index funds. The VTI index fund, you could probably find other different index funds, Vanguard index fund. This has been around for a long time. And that's it. It's really kind of ordinary. And what is an index fund? It's just all of the companies in the stock market. And they just created one index for the price of all those companies, and they just take an average. There's debate about whether you should sort of weight it based on the value of each company or equal weighted. It's debatable in terms of what that means, and how that sort of plays out. And I don't really, I'm not, it's been so long since I've looked at that literature. It was back in the grad school days. I can't remember if there's any differences, but I don't think there is. I think they just end up using different things just to show, that they're basically the same thing. So we need to come back and say, am I somehow smarter than everybody else? If you say yes, I'm going to tell you this, you're stupid. And you're going to lose. And you're going to, I know that this is really painful to hear. You're going to lose. If it's not, you probably are going to do really well. So sometimes, most of you are probably going to lose pretty quickly. Some of you are going to lose in 10 years, right, by doing that. But, it's going to take you a long time. In fact, there's this old boiler room sort of play. What people would do is they'd sort of fake you. These sort of investment gurus would fake that you win a bunch of times in a row based on, some selection process. Anyways, I'm not going to go into it, but anyways, gives you sort of this false security that you understand what's going on, and you end up making stupid mistakes. So I never end up, I don't even know what I own, companies that I own, but I own all of the companies, and we do pretty well. You've been investing for a long time, and that's what you do, day in and day out. Now, let's say you want to play in the market. What would I do? Honestly, I wouldn't. But if you were wanting to do something, and you really had confidence in it. But again, if you have confidence in something, you're stupid. You don't get what's going on. There's far more complexity than you ever imagine. There's people that invest so much more money than you, and they have computers that are so much smarter than you. Every day, most of the trades on the stock market now are done by computers. You can't beat this stuff. But let's say you wanted to, which I wouldn't recommend. You might look at, okay, what are the long run trends in the market? Like extremely long run trends. We're moving to battery power, maybe, right? It could be that battery power is a temporary thing, and we move actually to hydrogen fuel cell, or we move to solar pretty relatively quickly. Solar powered vehicles and things like that. So, you could invest in something like that, but I'm going to say you're probably going to lose because you don't understand what's going to happen. We're human. We don't get it. We don't understand it. We're dumb. And we are dumb. We can't forecast the future, right? We're just really bad at it. So why go there and believe that you can actually do it? I know this is hard to take, but it's the truth. I want you to be extremely wealthy by the time 15 years from now. If you paid attention to this, you're probably going to do okay. Invest 15% of all that you make in either index funds or some long, it's been around for a long time, mutual funds that just basically match the returns of the stock market. There's different ones that are out there. American Funds has some pretty good ones. Vanguard is pretty good. It just depends on whatever you want. And that's what you look for. Time in and time out. There's no magic. All right. Take care. And we'll see you on the next pod. Bye.